So first, let's kick this off. Our event partner for today is leading retail trading and investment platform IG. And if you don't already know, IG provides ambitious, self-directed individuals with the products, technology, and insights they need to access opportunities in the financial market since 1974. We'll drop a link in the chat box now so you can learn more about them. And a disclaimer before we begin, your capital is at risk. 76% of retail investor accounts lose money when trading spread bets and CFDs with this provider. And you should consider whether you understand how spread bets and CFDs work and whether you can afford to take the high risk of losing your money. Today, we're very fortunate to have Martin Harris with us. Martin is a portfolio manager at IG Smart Portfolios, and so he has lots of experience building and managing portfolios. Very good to have you with us today, Martin. How are you doing?
Theodora, thank you very much for having me. I'm doing great, thank you. How are you?
Very good, very good. Just before this webinar, I was taking a look at your bio, and it seems like you have quite an interesting job. It's very relevant to what we're discussing today. So if you don't mind sharing with us kind of, what your job entails.
Great. Yeah, I do have an interesting job. It's a job that I love. I think, if you enjoy financial markets, you enjoy news and, the craft of trying to beat the market through investing, you'll enjoy being a portfolio manager. So what I do at IG is I run our smart portfolios, and IG smart portfolios are an investment product that we work in collaboration with BlackRock on. So we get an asset allocation from BlackRock, and we do our own in-house research, and we utilize their framework to invest our clients' money. So what it is in relation to IG, many people know IG as a trading platform. You can trade stocks and shares, you can trade CFDs, spread bets and indices, but you can also do long-term investing. And so for the clients in the UK, they'll understand things like ISAs and SIP accounts. So those are your tax-free savings accounts, as well as your pension funds. You can wrap your smart portfolio inside one of those tax efficient wrappers. And that's one of the offerings that we have. So there's sort of three ways that you can invest in a smart portfolio: in a normal stocks and shares account, inside a tax-free savings account, and in a pension fund.
Great, thanks, Martin. We're just talking about investing, and you just mentioned, investing is such a, it's such a complex universe. There's so many thousands of products to choose from. When I think about my own portfolio, I'm trying to diversify across different companies, different markets, different sectors, countries, and different asset classes. How does one even start thinking about building a portfolio?
I think everyone who's ever traded the markets would love to know what the answers to the perfect sort of portfolio construction. I think to your question, I mean, Theodora, you're looking in the right way. There are a few frameworks that we can utilize, particularly around diversification, that help us get exposure to all sorts of markets that are going to have different catalysts that drive earnings and that drive growth. And so what we're looking for is, one, where is the diversification coming from? Two, we're going to start looking at who the portfolio is aimed at. So if you, so for example, at IG Smart Portfolios, we've got 5 different portfolio offerings, one which is a conservative profile, all the way to a more aggressive profile. And so depending on your situation, you would choose what type of risk appetite that you take. And so I don't want to discuss it too much, but risk appetite, you're looking at your time horizon, you're looking at your wealth criteria, you're looking at your income, and you're looking at really your end goal. So you've got an idea of diversification, you've got an idea of what your risk appetite is. And from there, you can start to decide where you're going to allocate money. And so if you're more conservative, very broadly, you would start to look at, less volatile markets. You want to be more in sort of fixed income cash markets. And if you're highly aggressive, you're young and you've got, a decent income, you're going to want to then invest aggressively in equity markets. And those are the sort of the two extremes of the spectrum.
Great, thanks for that. It seems like, when you're thinking about building a portfolio, the first thing you kind of need to know is your own individual investment goals. Can you afford to take more risk or not? Are you close to retirement? or do you still have at least 50 more years of work ahead of you? So in terms of building a winning portfolio, a portfolio that can last for years, what do you think are the essential elements of that?
Yeah, Theodore, I think I'm gonna be repetitive here, but ultimately, diversification is the key kind of criteria that you need to meet when it comes to a long-term winning portfolio. I'm sure a lot of your community will have seen the stats around being invested, time in the market versus trying to time the market. And ultimately, you want to stick around for when there is the uplift in global markets. So you will often miss the opportunities because roughly 80% of the growth is happening 20% of the time that you're invested. So you want to try and maximize the opportunity of getting that growth in your portfolio whilst downplaying any risk. And so it comes down to basic things like, are you invested in markets that have the opportunity to grow, whilst also your investment is diverse? And when I talk about diverse investments, we're talking about the correlation between your different positions to each other. So you don't want to be too concentrated in one particular sector. I mean, typically what we saw during sort of pandemic was an over concentration in the US tech sector. And what that led to is 2020, 2021, thriving portfolios, outperforming the general markets. And then in 2022, as we have this rising rates environment, we start to see a lot of weakness in that tech sector. So you don't want to be too concentrated, but you also want to be too diversified, where you effectively aren't so widely invested that you may as well just be in a global ETF, MSCI World ETF, somewhat spread across every market that you can imagine. So you want to try and find a balance between highly concentrated and highly diversified. And that is going to depend on your circumstances, right? It's what we spoke about before. What is your risk appetite? How much time do you want to spend investing? Are you the type of person that wants to spend every day or on a weekly basis monitoring your portfolio, looking at the markets, or do you want to buy something and leave it, rather let someone else manage it perhaps? So that's where you need to decide how you want to manage your portfolio.
Yeah, I think, Martin, you brought up a good point. A lot of us are not finance professionals, so we don't have the time to sit in front of our Bloombergs and monitor our stocks. What would you say is a good way, a good simple way? You talked about understanding the correlation of the investments in your portfolio, how they move. If the economy is going well, which stocks tend to perform well, which stocks kind of act as a hedge. Where would you start in terms of understanding correlation of assets in your portfolio? I'm assuming that you don't have much time to be spending in front of your Bloomberg. So that's the first part of my question. And I guess the second part, you mentioned another good point about diversification, and you mentioned that there is the risk of over diversifying. What would you think is, how would one know what is a good amount of diversification, and that we're not over diversifying?
Okay, so there's a few parts of that. I think the risk of being over diversified is that you miss out on sector specific growth opportunities. But typically by over diversifying, you've also reduced your risk significantly. So it's not necessarily a bad thing, probably a lot less risky than being over concentrated. So you'd want to lean towards being over diversified over a long term. I think I'll try and go through each of those questions. So one of your comments was on how do you understand the correlations between the stocks. I think that on IG and other platforms, you're able to get basic tools which will show you those type of filters that you can go through in terms of sectors, but there's also loads of information out there with regards to historically where the correlation comes from. So really basic ones that people should try and take a look at, growth versus value investing, okay, energy and materials versus things like fixed income. So energy and materials, highly inflationary environments that they perform in, versus fixed income performs really poorly in an inflationary environment and a rising interest rate. So what you want to try and do is encompass enough of each of those sectors to build a well-rounded portfolio. I could probably spend an entire day speaking about correlations within a portfolio, but I'd highly recommend that be your next bit of reading. And I'm sure there's some stuff on Finimize that might discuss, the correlations of the sectors and which markets typically outperform in certain environments. Just as a basic guide for people in the webinar, what we're seeing at the moment is a rising rates environment as well as a increasing inflation environment. So what works well in a rising rate environment, you want to be able to pass on those rising rates to the consumer or to the end buyer. So typically your financials do really well because they're able to give out loans and at a high interest rate, and they get to scoop, most of that kind of interest rate differential. Energy markets also do all right. Then in a high inflation environment, energy markets perform well. So the one that performs well in both high interest rates and high inflation are energy markets. And that's what we saw through the whole of 2022, energy markets outperforming. Now 2023, we're seeing that slow down as the interest rate markets as well as the inflation market slowing down.
Yeah, thanks,
I hope
Martin.
I've answered that question.
Yeah, I think you made a very good point about understanding how each of the asset classes respond in a different regime. In this context, are there any specific stocks, themes, regions, or asset classes which you think are particularly exciting now?
Yeah, so I think going back to the point that I've just made is that there's been no question that this year, January, February, what we've seen, this rally has been particularly powerful and broad, but to believe that it's going to be sustainable, we need to have a good idea about what the potential recessionary impacts could be. Everyone has been talking about the kind of manufactured recession that we're seeing in the developed world due to central banks trying to tighten. So there has been a bit of easing recently, so I'm not going to discuss too much on that, but expectations are that you have a recessionary environment towards the end of 2023. And the soft landing approach that is really widely used by the media at the moment is your kind of positive outcome, and a hard landing is the negative outcome. And we're seeing this rally in markets based on the soft landing anticipation. I think the problem with this is that despite a strong labor market reinforcing that soft landing approach, and that's across global markets, particularly if we talk about where we are in the UK, but we look at the US, UK, Europe, that's what we're seeing is, the labor market reinforcing the soft landing. We also, though, have the indicators that are disagreeing with that in terms of you've got the US Treasury yield curve inverted, and there's a sort of composite leading indicators that have reinforced a stronger recessionary call. Today, 1:30 UK time, so 15 minutes, we're going to get a CPI reading, and that's actually going to be something that we're looking at. That's going to drive a lot of the decisions that we make over the next few weeks. We're waiting for this CPI number. So I think just prior to the CPI number coming out, what we're looking at, all right, so with S&P 500 earnings yield at the moment is roughly equivalent to their short-term US Treasury bills. So it makes sense to actually allocate capital towards credit, high-yield corporates in US as well as Europe, until we've got a more comfortable understanding of where we're going to allocate to equity markets. If we want to talk just about equity markets, we're always trying to look at where the catalysts are coming from. What is the second order effect of a particular drive in a market? I think the two big factors at the moment are, one, geopolitical risk in Europe, as well as potentially geopolitical risk in China. And secondly, the big catalyst at the moment is going to be the Chinese reopening trade. So you've got all of this pent-up demand from China being, due to COVID lockdowns. They've now reopened their economy, and in particular, what we're interested in is reopening travel. So similar to what we saw across US, Europe, where there was huge pent-up demand for goods, which then pivoted into pent-up demand for services. We're seeing that now with China. So pent-up demand for goods is probably easing, and what we're looking at is that pent-up demand for services as well as luxury goods. So that's probably the sector where we're looking at. At IG Smart Portfolios, we are taking a broader view around strategic allocation. We're using ETFs because of their low-cost nature. But if people are looking at stocks, and this is just for educational purposes, in the luxury goods market, you've got the three big players, which is LVMH, Kering, and Richemont in Switzerland. And those luxury goods stand to take, the best benefit out of this reopening trade in China. That being said, large political risks. You've got tension between the US, China, and Taiwan. You've got tension between Russia and Europe. And so if that tension between the US and China were to escalate, the investments in luxury goods, as well as the investments into the Chinese economy, big media players such as Tencent, the likes of Alibaba, that's where, where you could see large sort of risk going into those Chinese players.
Yeah, but very interesting. I think it was at LVMH last earnings call where the CEO actually mentioned that their shops in Macau is all packed to the brim now. So you can definitely see that Chinese demand coming, pent up Chinese demand.
I think the likes of Richemont are making 11% out of Hong Kong. 11% of total earnings are all coming out of Hong Kong. So any kind of easing and sort of boost to those economies, you see that coming through in the luxury goods markets.
Yeah. Just a reminder, if anyone else has any questions for Martin, please pop them into the question box. One last question for you, Martin, before we dive into Q&A. What are the top tips you have learned from managing a portfolio?
Right. So I think managing a portfolio versus, I'll talk about it, managing a portfolio versus just trading individual stocks. I think managing a portfolio, you typically are trying to manage overall portfolio risk rather than just individual stocks. And looking at just stock picking, what you're trying to do is you're trying to get strategic allocation to the right sort of themes where you think there's going to be growth, as well as enough downside protection. And some of that downside protection is going to come in the form of hedging. And so you're looking at things like currency risk. You're looking at event-driven risk. And what you don't want to do is be in a situation where the hedging starts to weigh down on the portfolio. So you want to have enough exposure that you're able to actually get the benefit out of the portfolio, but you also want to try and avoid some of the downside risks. And I think hedging is the most critical component. So for maybe some of the listeners, things like, if you've got large exposure to something like Amazon or Facebook, and you then want to try and reduce some of that risk without selling out of your position, you would then take a short or something like that on an index. But now unless you're matching your hedging one for one, you're actually increasing your exposure, because now, if you are just taking a look at an index and it's Apple might be 20% of the particular index that you are hedging against. And so you now actually have your full exposure to Apple plus 80% of non-Apple that you're exposed to when you hedge out. So that's something that really takes a bit of getting used to and working out. And I think the next thing is, the shorter your time frame, the more work that you end up having to do. So by extending your time frame, you're able to take advantage of full cycles. I think you start to learn more about that. It's not about calendar time in terms of invested. You start to look at business cycles and credit cycles, things like that, and how your portfolio relates intrinsically. So that's really what I'd talk about, are those two points.
Great, Martin. I think you made a very good point about time frame. We're not all sitting in front of our Bloomberg, so the best way we can maximize our research is to be investing for the long term. And I think it's also important to realize that we don't need to have a perfect portfolio right from the start, and it's things that we tweak over time as we get understanding of how the assets correlate to each other, how they work. So yeah, not perfection at once.
I think on that point is that one is also, maybe to add to it, is being realistic about the returns that you can achieve. If you look at the most successful hedge fund managers of all time, they're looking at between 10 and 20% returns per annum. A lot of new investors come in, and particularly, around crypto, saw the opportunity to double your portfolio in a matter of weeks. You need to be slightly more realistic about the returns that you can achieve, and also understand that the majority of your returns are going to come from only a few of your trades that you make. And really what you're trying to do is that the bulk of your strategy is about mitigating risk whilst increasing your exposure to markets. And yeah, so really the returns are going to come from these seismic sort of thematic shifts in markets. When value invest, let's rather go to now, when you've got a highly inflationary environment, when you've got an increasing rates environment, that's where you get these thematic shifts, and you want to be around to scoop up those opportunities.
Yeah, very, very interesting. We have a couple of questions from the audience. We've got one from Paul. Paul is asking, for younger investors with a long time horizon, would you still recommend being heavily focused in equities, but with diversification just across different sectors and countries?
Yeah, absolutely. So one of the things we do at IG is when you start off with opening your smart portfolio, you go through a risk questionnaire, which is going to categorically put you in a position which shows where we recommend that you invest. And if you are on the younger side of 25, you've got this really long time horizon, and you've got decent earnings potential, you want to be focused on equity markets. And then what you would look at doing there is diversifying which equity markets you're invested in as a way of reducing risk. You wouldn't, if you're really short term and you're really worried more about capital preservation, you want to go into low risk investments like fixed income.
Yeah, and to that end, we're diversified across different sectors, and like in the last 5 years at least, the tech sector was outperforming. A follow-up question from Paul is that, would you recommend rebalancing frequently, or just letting your portfolio run so that the outperforming regions or assets just become a bigger proportion of your mix?
That's a great question, and like everything I might answer, it depends. I think if we were to try and simplify it, one, we advocate for dollar cost or pound cost averaging when you invest. So basically drip feeding your investments over time. What has shown is that over sort of long term, let's say a 10-year period, adding money on a monthly, let's say weekly, monthly, quarterly basis outperforms putting in one lump sum and just leaving it. So one, we advocate for dollar cost averaging, so continually adding to your investments over time. And then yes, rebalancing is important. It doesn't necessarily mean that you have to sell out of your positions. What it might mean is that you just stop adding to certain positions. So what we would look at, let's say in the current market, is you've got the UK outperforming the United States, all-time highs currently on the UK FTSE market, and we're starting to see valuations in the UK start to become a bit stretched. So would we want to continue to allocate more capital to the UK, or would we want to then start looking at markets where we see more value? And that's really the way to look at it, is that you don't necessarily have to now go and sell out of that particular market, but you can rather increase your weighting to areas that you strategically find more value.
Yeah, I guess that's a great point. It's just not to be completely invested at one point. It's to kind of stand on the sidelines and slowly build your position. And also, selling all your gains just also means you incur quite a big tax bill at the end of the year.
You're gonna pay the tax at some point in time, unfortunately. I think when do you want to sell out of your investment is when the environment that the reason why you invested, or the entire environment for that investment changes. Either the move is totally overdone. So a big thing that we saw was the online car dealerships from that really succeeded in 2020, 2021. That became quite an obvious one, is that as you started to see secondhand car prices and things like that fall off due to the easing of supply chains, things like that, you no longer want to have a large exposure to those sort of markets. And so that's when those start to come off, that's when you can start to sell out. But you need to, the theme around why you invested in that market needs to have changed.
Yeah. Great point. We have one question from Fiona. She's asking if you think the days of the 60-40 portfolio are over.
All right, that's a great one. No, I don't. So 2020 was really bad for the 60-40 portfolio. And I think just for everyone on the call, classically 60-40 was you go into 60% equity exposure, 40% fixed income. And for people who weren't watching, 2022, you have this increased interest rate environment. So if you're in a fixed income portfolio that's promising to pay these coupons and you come out of 2020, 2021, which has a zero or negative interest rate environment, the coupons that you're going to receive from your bonds are really low. And so now every month the rates are increasing. And so you're still stuck with a coupon that might pay 1%. And the future expectations for interest rates are at 4%. Your fixed income portfolio is going to look terrible. And so what we're seeing now is a complete normalization of those rates. So now has actually been, probably from late last year through to early this year was a really good opportunity to get into fixed income because of the normalization, high interest rates environments globally. So that was a good opportunity to get in. So 60-40, not dead.
Perfect, very clear, 60-40, not dead. We have a popular question here from Jenny. Jenny's asking, how do you choose a benchmark to measure performance? I guess if you're investing on your own, it's quite hard. Am I doing a good job? Am I not? Yeah.
So, all right, there's a few things when it comes to benchmarks. I'll try and be quick about this. One, if you are in a singular market, let's say you are in the US and you are putting all of your investments only in the US, you've got this huge hometown bias that, everything that you have exposure to is US related. Then you would benchmark yourself against something like the S&P 500. However, once you're fully diversified, and I'd recommend people go and, you can Google MSCI World ETF and take a look at how they have split up that ETF, and you can start to understand a diverse construction of a portfolio. You want to benchmark yourself in a similar fashion to how your portfolio is constructed. So for example, us at IG Smart Portfolios, we've got quite a large weighting to the UK, but we've also got a large weighting to the US and Europe. So we would want to have a blended weighting across those three regions, as well as then how fixed income is performing. Let's say on our aggressive portfolios, we're doing between 20 and 30% fixed income. So that's where we would want to benchmark, as a weighted benchmark across those markets, but wouldn't be too concerned about benchmarking. What you really want to look at is how you're doing against inflation. I think that's the primary benchmark over the last year, is to perform against inflation.
Yeah, I guess that's a very good point. As long as you're keeping the value of your money, that's great. That's great returns. I'm afraid that's all the time we have with Martin for today. Thank you so much for joining us today, Martin. And I know there are a couple of questions still on Q&A, and I believe your LinkedIn profile might be dropped into the chat, so you might have a couple of people kind of.
Yeah, not a problem. Yeah, welcome to reach out.
Great.
Hopefully I'll be able to answer your questions.
Yeah, I hope this has been enlightening and informative for everyone here. Have a happy Valentine's Day, everyone.
Thank you, Theodora.